Catherine, and welcome to Heir Necessities, the podcast that turns complex financial concepts into real talk for Gen X, Millennial, and Gen Z inheritors. I'm a certified financial planner, I'm an inheritor myself, and I'm the founder of Sunny Branch Wealth, which is a fee-only registered investment advisory firm that works exclusively with current and future inheritors. Every episode of Heir Necessities, I break down a different topic related to generational wealth and inheritance. And on today's episode, I am taking a deep dive into the taxes that inheritors need to understand. It's not everyone's favorite topic, but it's something that's super, super important to have at least a basic understanding of. So let's dive into it. The first thing that we want to talk about taxes is understanding the taxes that you will pay as an inheritor versus the taxes that the estate you are inheriting from will pay. And this is a really important distinction. Sometimes it feels like it's not that important of a distinction because it kind of comes out in the wash, right? Like if the estate pays it, it reduces your inheritance. If you pay it, it reduces your inheritance. But there is a lot of mental energy and stress associated with paying taxes. And so understanding what isn't your responsibility is really helpful. So let's start with a basic primer on estate taxes. Estate taxes are levied based on the value of a decedent. So the decedent is just a fancy way of saying a person who died. I'm going to keep using it because it's an expeditious word. So estate taxes are levied on the total value of a decedent's estate. There are federal estate taxes, and then several states, 12 states plus DC to be specific, also have state estate taxes. So right now, the federal estate tax is at a little over $13 million for an individual, so about $26 million for a married couple. So most people won't have to deal with the federal estate tax unless their estate is greater than $13 million or $26 million if they're married. Then on the state level, if the decedent lived or owned property in a state with an estate tax, then their estate is going to be responsible for paying that estate tax. So, for example, I live in Oregon. The estate tax exemption here is $1 million. So if I die and I am worth, $4 million, say when I die, then $3 million of my estate is going to be taxable, not at the federal level, remember, because you have that $13 million or $26 million exemption, but at the state level here in Oregon. But think about someone who lives in a state, say like Florida, that doesn't have an estate tax, but they also own like a $2 million beach house on the coast here in Oregon. They don't have to pay any estate tax on anything that they own in Florida, but that real property that's situs in Oregon, that exists in Oregon, is going to be subject to Oregon estate tax. So even if the person who died doesn't live in a state that has estate tax, if they owned a real property in a state with estate tax and that real property is valued at more than that state's estate tax exemption, then they still may have to pay an estate tax. But if you're not the executor of an estate, then you don't really need to worry about estate tax. You should know that it exists because it may reduce the value of what you're going to get as an inheritor, but you don't actually have to interact with it. It's the responsibility of the person who's actually settling the estate to deal with the estate tax. There's also inheritance taxes. Now, there's no federal inheritance tax, but there are 6 states that have inheritance taxes. And those inheritance taxes are based on where the decedent lived and owned property, again, just like estate tax, not where you live. So if you live in a state, say like Maryland, with an inheritance tax, but the person who died lived in Washington state, which doesn't have an inheritance tax, then you don't have to pay that inheritance tax. Again, it's not about where you lived. It's about the place where the person who died lived. And so you can flip that. If the person who died lived in Maryland, but you live in Washington state, you may be responsible for paying that inheritance tax on assets you inherit because they came from a Maryland estate. Again, there are only 6 states that have inheritance taxes. It's not super common, so it's not something that most people have to worry about, in the same way that state estate tax is not something that most people have to worry about. Before we jump into the part that most people are actually going to care about, which is like, what taxes do I actually have to pay? Okay, I don't have to worry about estate tax. You said I probably don't have to worry about inheritance tax depending on where I live. Like, then what do I actually have to worry about? I also want to note that estates also have to pay their own income tax. So if someone dies, say they have a taxable estate that's worth like $15 million, that estate is going to be generating income. Like the assets in that estate, whether it's rental property or investments or whatever, those assets are going to be generating income, and the estate itself has to pay taxes and file a tax return on that income. And so I just want to flag that for anyone who's out there listening to this and is an executor of an estate, flagging the fact that not only do you have to file the decedent's final income tax return for themselves, you may also have to file an income tax return for the estate itself. Again, if you're just inheriting, you're not an executor or anything of an estate, you don't need to worry about that. But since this is a podcast episode about taxes, we're going to talk about the taxes also that an estate itself needs to pay. Okay, so now we are diving into the meat of the thing and what most people actually want to know. It only took me like half the episode to get into it, which is what taxes are you going to pay as an inheritor? And this is something that is really difficult a lot of times for people to understand. So I want to start by saying it very slowly and very clearly. Inheriting itself is not a taxable event. So if you inherit $5 million from an estate, the act of transferring that money from the estate to you is not taxable. Okay? You are not going to owe any money in taxes simply because you inherited assets and they moved over into your own name. Now, that being said, depending on the assets that you inherited and what you plan to do with them, there may be taxes that follow after you receive your inheritance. But I just want to be very, very clear, because this is something that's confusing to a lot of people, because in the vast majority of cases, when you get income, right, you have to pay taxes on that income. An inheritance is a transfer. Money moves from one person to you. And if it's just a straight transfer of assets, you are not going to owe taxes on that. Now, if assets were in your name and were sold and then the cash was transferred to you, that's a different story. But I'm literally just talking about, again, like you receive a distribution from an inheritance or a straight transfer over of assets, or an account moves from the decedent's name into your name, that is not a taxable event. But the tax treatment of inherited assets, so once they're in your name, the tax treatment kind of goes like a little bit wild depending on what that asset is. So once these assets are in your name, let's talk about what taxes you can expect. So the first thing to talk about here is called the step up in basis. And it's probably something that you've heard about before. Basically, when someone dies, the majority of their assets are going to receive a step up in basis. And what that means is that the cost basis of that asset is equal to its value on the day that person died. Let me give an example to explain what that actually means. So if 40 years ago, I bought a share of Microsoft stock for $1, and I've just been holding that share of Microsoft stock. It's split a couple times, whatever. Now, the value of my holding in Microsoft is, call it $100,000. This isn't necessarily supposed to be a realistic example. So I bought my share of Microsoft for $1. Now it's worth $100,000. If I wanted to sell my Microsoft position for $100,000, I would owe tax on $999,999 of unrealized capital gain, because my cost basis is $1, which is what I purchased it for, and my current value is $100,000. So basically on all of that $100,000 minus $1, that would all be taxable if I sold it while I was alive. But instead, if I died holding onto that stock and then I turned around and gifted it to one of my heirs, that heir would get a step up in basis. So now, instead of inheriting my $1 cost basis, that person has a new cost basis, which is equal to the value of that stock on the day I died. So my heir's cost basis is $100,000, which was the value of that stock on the day I died. So if then my heir wants to turn around and sell all that Microsoft, it's still worth $100,000. They don't owe any taxes. So this is a huge, huge tax benefit that, again, disproportionately benefits wealthy people who are the people who own assets, but it can apply to everyone. So the step up in basis, what that means is that if you inherit assets through just a regular taxable account, and then you want to sell those assets, depending on what their value has done between when the person died and when you actually got access to them or want to sell, you could be owing little to no tax on the sale of those assets, which is great. The trick to this is that not all assets get a step up in basis. So if you inherit assets that were in a revocable trust before someone died and then they passed through to you, assets held within an irrevocable trust do not get a step up in basis. So just because you inherited securities, you shouldn't assume that they get a step up in basis. You should always check with the estate executor, the CPA, or the attorney to make sure of what the cost basis is before you move forward with any sales. The second piece of taxes and inheriting that usually trips people up is inherited IRA accounts. And I have so many blog posts about this, a whole episode of Heir Necessities about this. So if you're interested in learning more about this, this is going to be a very brief overview, but I do have a lot more deep dive content. I'll put links to that in the show notes. If you inherit a taxable IRA or 401k account, every dollar that you pull out of that account is taxable income. So if you inherit $1 million IRA, the step up in basis doesn't matter. If you pull $100,000 out of that IRA, that $100,000 is taxable income to you. And in the vast majority of cases, you are going to be required to fully empty that $1 million IRA account within the 10 years after the date of death of the person who died. So inherited retirement accounts are actually the single biggest tax issue that inheritors face. And it's compounded because most people save in retirement accounts, which means most people are going to inherit taxable retirement accounts. Because there was a big change about these requirements about how you have to take money out after you inherit a taxable retirement account, it's a huge tax burden that most inheritors don't realize they're facing. There are other taxes that you might have to worry about after you inherit. Like if you inherit property, you're going to have to worry about, like the taxes on the income coming off that property. But broad strokes, the two most important things to know about the taxes after you inherit are to check if you got a step up in basis, and if you did, understanding that you may be able to sell those positions with little to no tax impact, and then to understand the tax implications of any inherited taxable retirement accounts that you received as part of your overall inheritance. If you have any more questions about taxes and inheritances, this has been a really down and dirty look. I'll drop links to other content I've created that's focused on this topic. You can always feel free to send me an email, send me a DM on Instagram. I'll drop all my contact information in the show notes too. And until then, I'll look forward to chatting on the next episode of Heir Necessities.